The world did not wake up to stability. It woke up to confusion disguised as relief. Here is your improved and polished version of the script, rewritten in a more professional, cinematic, and coherent documentary style, while keeping your original intensity and message intact. Within a single trading session, a statement from Iran's foreign minister reshaped global markets in a way few analysts had fully anticipated. The message itself was simple, but its impact was immediate and powerful. The Strait of Hormuz was completely open. Within hours, global financial systems reacted sharply. Oil prices fell rapidly, erasing weeks of geopolitical risk premium. Brent crude dropped nearly 10%, while West Texas Intermediate slipped into the low $80 range. On Wall Street, the reaction was equally dramatic. Stocks surged, the Dow Jones Industrial Average gained nearly 1,000 points, and the S&P 500 climbed to record highs above 7,100. To many investors, it appeared as though the crisis had ended. But beneath the surface, the reality was far more complex. This was not simply a story of de-escalation. It was a story about one of the most strategically sensitive energy corridors in the world, the Strait of Hormuz, through which nearly one-fifth of global oil supply passes. Even minor disruptions here have global consequences, affecting inflation, trade flows, and economic stability across continents. And despite the headline declaration of openness, the physical system had not fully normalized. Shipping data, insurance pricing, and port operations all pointed to a different reality. Oil flows were improving, but still below full capacity. This disconnect between financial perception and physical reality became the central tension in global energy markets. Markets reacted to intent, but energy systems respond only to execution. Tankers must move, ports must operate, insurance risks must normalize, and infrastructure damaged or strained during weeks of escalation must be restored before true stability returns. The Strait of Hormuz is not merely a shipping route. It is a geopolitical pressure point where military strategy, global trade, and energy dependency intersect. Every day, tens of millions of barrels of crude oil pass through its narrow waters, supplying economies across Asia, Europe, and beyond. When that flow is disrupted, even partially, the impact spreads instantly through global supply chains. To understand how the situation reached this point, the crisis must be traced step by step. It began with a sharp escalation following coordinated military strikes on Iranian infrastructure, which immediately triggered a reassessment of geopolitical risk across global markets. Oil prices surged as traders priced in the possibility of broader conflict and sustained supply disruption. Iran's response was not a full closure of the strait, but a gradual tightening of control. Selective transit permissions, increased inspections, and rising uncertainty for commercial shipping. Certain vessels were allowed passage under specific conditions, while others faced delays or rerouting. At the same time, insurance premiums for shipping through the Gulf rose sharply, making transit economically and operationally difficult even where physically possible. This created a progressive constriction of global oil flows rather than a single shutdown event. By early March, global energy agencies began reporting significant reductions in effective supply circulation. The impact was not only on production, but also on transportation, logistics, and risk management systems. Pipeline alternatives provided limited relief, but could not replace the scale of maritime exports through Hormuz. What emerged was a system under structural stress, not collapse, but sustained constraint. Diplomatic efforts followed, leading to temporary ceasefire frameworks and brief market relief rallies. However, these periods of optimism repeatedly collided with physical data that showed incomplete normalization. Shipping remained inconsistent. Infrastructure recovery lagged behind political announcements, and risk perception remained elevated. Then came the announcement on April 17th. The Strait of Hormuz was completely open. Financial markets interpreted this as a turning point. Oil prices collapsed, and global equities surged in response to perceived stabilization. But three different realities were unfolding simultaneously. Politically, Iran framed the announcement as part of a conditional de-escalation process tied to broader regional negotiations. Operationally, naval presence and enforcement activity in the region continued, limiting full commercial normalization. Physically, tanker movement increased, but not enough to return to pre-crisis levels. This gap between declaration and execution is where instability persists. Shipping firms continue to operate under elevated risk assessments. Insurance costs remain higher than normal, and a significant portion of global tanker traffic is still behaving cautiously, delaying or rerouting voyages. At the same time, oil futures markets reacted faster than physical supply chains, creating a temporary divergence between financial pricing and real-world availability. This divergence is not unusual in geopolitical shocks, but it is critical because futures reflect expectations. Physical markets reflect reality. And when those two are misaligned, volatility often follows. From a strategic perspective, the Strait of Hormuz remains one of the most important choke points in global energy security. It connects Gulf producers to global consumers and has no scalable alternative route capable of fully replacing its capacity. Even partial disruption therefore creates global ripple effects. Beyond economics, the crisis has also reshaped geopolitical assumptions. Maritime security in the region is no longer treated as a fixed condition, but as a variable risk environment. Energy importing nations are now reassessing long-term dependency on single transit corridors, while energy exporters are reevaluating infrastructure resilience and diversification. Experts broadly agree on one key point: the system has not fully stabilized. It has only transitioned into a conditional phase of partial recovery. Tanker flows are improving, but not normalized. Diplomatic tensions have eased, but not resolved, and operational risks remain embedded in the system. At the same time, there is another interpretation, one that suggests the market reaction may not have been irrational. From this perspective, oil prices did not collapse due to misunderstanding, but due to recalibration. Traders responded to reduced probability of worst-case disruption scenarios, even if full normalization had not yet occurred. Markets, by nature, price the future, not just the present. And in the hours following the announcement, even partial improvements in shipping flow and reduced escalation risk were enough to justify a sharp repricing of oil and equities. This interpretation suggests not confusion, but forward-looking adjustment. Still, even analysts who support this view acknowledge uncertainty around timing, because the speed at which physical systems recover determines whether stability holds or whether volatility returns. And that is the key risk going forward. Even in partial normalization, fragile systems can reverse quickly if political or operational conditions shift. The consequences of this crisis are already extending beyond oil markets. Energy prices influence inflation, manufacturing costs, transportation, food supply chains, and national fiscal balances. Even temporary disruptions create delayed effects that continue long after prices stabilize. This is why economists describe energy shocks as lagged systemic events. The impact unfolds over months, not days. Geopolitically, the crisis has reinforced a fundamental reality. Energy security is now inseparable from political stability. Countries dependent on Gulf energy routes are accelerating diversification strategies, increasing reserves, and reassessing long-term exposure to maritime choke points. For global markets, the result is likely a higher baseline of risk sensitivity. Even after stabilization, future pricing may reflect a permanent adjustment in geopolitical risk assumptions. Looking ahead, three key variables will determine the next phase: whether tanker traffic returns consistently to pre-crisis levels, whether naval enforcement conditions in the region are reduced, and whether the ceasefire framework holds under political pressure. If these conditions stabilize, markets may fully absorb the shock as a temporary disruption. If not, volatility could reemerge quickly. What is clear is this: the Strait of Hormuz has not simply returned to normal. It has entered a fragile equilibrium where stability exists but is not guaranteed. And in such environments, the difference between calm and crisis is often measured not in headlines, but in the daily movement of ships through a narrow and contested waterway. Because in global energy markets, declarations can move prices, but only physical flows determine reality. And that reality is still unfolding.